Welcome to Talk Tickers.
Hello.
Usually we are here breaking down the quarterly reports, the guidance revisions, the stuff that makes the ticker tape at the bottom of the screen flash green or red.
All things public markets.
Exactly. But today we are going off-road. We are leaving the public exchanges entirely and walking into the quiet, slightly intimidating conference rooms of the private markets.
I like that. Yes.
We are talking about the mechanics of capital.
Which sounds dry, I know. It sounds like accounting. But you have to realize this is where the actual money is made and, frankly, lost in some of the biggest deals in the world.
It's the plumbing.
It is absolutely the plumbing. We aren't talking about stock picking today. We're talking about the pipes. And the thing about plumbing is you don't notice it at all until a pipe bursts and floods your entire basement.
Right.
In private equity and venture capital, that plumbing is the capital call. And a lot of people get flooded.
It's a fundamental disconnect that I think trips up a lot of people, especially those who are used to the public markets, like our usual audience.
Sure.
If I want to buy, say, $100,000 of NVIDIA stock right now, I open my brokerage app, I tap buy, and poof, the money is gone.
Instantly.
The cash leaves my account, the shares enter my account. It's a simultaneous swap.
Right. That's immediate settlement, T+0, basically.
Yeah.
The decision to invest and the funding of that investment happen in the exact same second.
But in the private markets, and it doesn't matter if we're talking about a massive KKR buyout fund, a small venture capital firm, or, a real estate syndicate, that relationship is completely severed.
Completely broken. You make the decision to invest today, you sign the documents today, but you might not actually pay for that investment for 3, 4, maybe even 5 years.
And that gap, that massive cavern of time between signing the subscription document and actually wiring the cash is what we're going to unpack today.
Yeah.
Because it turns out that gap is where all the incentives, all the risks, and frankly, a lot of the financial engineering hides.
It creates a completely different psychological and mathematical reality for the investor. It's a total paradigm shift. In public markets, you buy a stock, you have an asset. Simple.
Right.
In private markets, for the first few years, you don't really have an asset. You have a liability.
A liability. Say more about that.
You have a legally binding obligation to pay huge sums of money, often on very short notice. And if you mishandle that liability, if you can't come up with the cash when they ask for it, well, the consequences are draconian.
We're definitely going to get into those consequences. I've seen them called the nuclear options for defaulting investors a little later in our deep dive.
They're not pretty.
And we are definitely going to spend a good chunk of time on something called subscription lines, which is a piece of financial engineering that has, I think it's fair to say, completely warped how returns are calculated and presented.
Oh, it's changed the game. For better and for worse.
But let's start at the absolute beginning, the definitions. Because in this world, words have very specific, legally binding meanings that are, often different from just standard English.
They do. And the most important distinction, the one that everything else is built on, is between committed capital and cold capital.
Okay, let's start with committed capital. This is the big, flashy headline number, right? When we see a press release that says, Blackstone raises a $25 billion fund, they are talking about committed capital.
Exactly. That is the marketing number. That's the number that gets you on the front page of the Wall Street Journal. But think about what it actually represents. It is not money in the bank.
Right.
It is a contract. It's a collection of promises. When an investor, they're called a limited partner or an LP, this could be a pension fund, a university endowment, or a very wealthy individual, signs up for that fund, they're signing a subscription agreement. And let's say you commit $10 million. You are not writing a check for $10 million that day. You are legally promising that over the lifetime of the fund, which is usually 10 years, you will provide up to $10 million when you are asked for it.
So it's like a credit limit on a credit card.
That is the perfect analogy. It's almost exactly like a business line of credit or maybe a construction loan. If a real estate developer gets a $50 million loan to build a skyscraper, the bank doesn't just dump $50 million in their checking account on day one.
No, of course not.
The bank says, we approve you for up to $50 million. Come ask us for it as you pour the concrete, as you put up the steel. Committed capital is the ceiling of your liability. It's the maximum you could ever be asked to pay.
Okay, so that's the promise, the big number. Then we have the other side of the coin called capital.
Also known as paid-in capital. Yeah. This is the reality. This is the show me the money moment. This is when the GP, The general partner, the firm actually running the fund, finds a company to buy and sends out an email saying, okay, everyone, it's time. Send us the money.
So this is the cumulative amount of cash that has actually moved from my Bright account to the fund's bank account.
Correct. It's the total sum of all the drawdowns you've funded to date. And this is the number that really matters for performance, correct?
It is the only number that matters for calculating the efficiency of your money. It's the denominator in all the important metrics.
Right. When you see a metric like TVPI, that's total value to paid in capital, the PI is paid in or called capital. If you committed $10 million, but they've only called $2 million so far, and your stake in the fund is now worth $3 million.
My return is based on the $2 million that's actually at work.
Exactly. Your return is 1.5 times your money. It's not based on the $10 million you promised. The other $8 million is, for the purpose of that calculation, irrelevant.
Which makes sense, but this creates a third bucket here, which is the gap between those two numbers, the uncalled capital.
The industry term, and you hear this all the time, is dry powder.
Dry powder.
And this is the number that keeps economists and market analysts up at night. It is the aggregate amount of money that all these investors have legally promised to hand over, but hasn't been asked for yet. It's a measure of future purchasing power in the private markets.
And looking at the data from, the last couple of years, 2024 and into 2025, that mountain of dry powder is historic.
It's absolutely massive. By mid-2024, global private equity dry powder peaked at around $2.62 trillion.
$2.62 trillion.
With a T, yes.
Yeah.
That is $2.2 trillion of purchasing power that is legally committed but sitting on the sidelines, waiting for a target. It's an enormous overhang on the market.
I want to clarify one more definition before we get into the mechanics, because I saw a distinction in the notes that I think is really subtle but important. The difference between called capital and invested capital.
Yeah.
To me, those sound synonymous. If the fund calls my money, aren't they, investing it?
You would hope so, and you'd think so, but no, not always. This is where the leakage happens in the system.
Leakage.
Okay. Called capital is everything the fund asks for. That includes the money to buy the shares of the target company, yes. But it also includes money to pay the fund's legal bills, to pay the due diligence consultants, the travel expenses for the partners, and crucially, the management fees.
The famous 2 and 20, the 2% management fee.
Exactly. So imagine you commit $10 million. The fund's management fee is, say, 2%. For the first year, they might issue a capital call for $200,000 from you just to pay the management fee.
So that money isn't buying equity in a startup or a company?
Not a single dollar. It's paying for the lights in the GP's Park Avenue office. It's paying the salaries of the associates. So invested capital is the net amount after all those fees and expenses that actually goes into buying the portfolio companies.
This is a really, really important distinction for an investor to get their head around because of the drag it creates on your returns.
Immense drag.
If I send you $100 and 15 of it immediately goes to fees and expenses, I'm only putting $85 to work from day one. That $85 has to work incredibly hard just to get me back to break even on the $100 I sent.
Exactly. This is the entire concept of the J-curve.
The J-curve.
In the early years of a fund, your returns are negative. You are sending money out. That's the downward slope of the J. And a big chunk of it is vanishing into fees and startup costs. Your investment is technically underwater from day one. It takes time, years sometimes, for the $85 of invested capital to grow enough to cover the $15 of dead capital and start generating a real profit. That's the upward curve of the J.
So, okay, we have the definitions. Why do we do it this way? I mean, why this complex dance of I promise and you call? Why doesn't the fund just take my $10 million on day one, put it in a treasury bill or something safe, and then just draw from that account whenever they find a deal?
That's a great question.
It would certainly be easier for me as an investor. I wouldn't have to worry about keeping cash ready on short notice.
It would be much, much easier for you operationally, but it would be an absolute disaster for the fund's performance metrics. And it all comes down to the tyranny of the IRR, the internal rate of return.
IRR. We hear this metric constantly. It's the flashy number in every single pitch deck. We generated a 30% net IRR for our last fund.
Correct. It's the headline performance metric. But the key thing to understand about IRR is that it's a time-weighted metric. It measures the speed of wealth creation. How fast did you make the money? And because of that, it is incredibly sensitive to the duration of the investment.
Okay, walk me through that.
Let's do a quick thought experiment. Imagine Fund A is old school. They take your full $10 million on day one, but it takes them 5 years to fully deploy it into deals, which is a very realistic timeline for a big fund.
Sure. They're not going to spend it all in the first week.
Of course not. So for 5 years, you have a large declining balance of cash just sitting in the fund's bank account. Maybe it earns, 4 or 5% in a money market fund in today's environment.
Which is not why I invested in private equity.
Not at all. That low return cash acts as an anchor. It's a drag on the performance. It pulls down the weighted average return of the entire fund. This is what's called cash drag.
Right.
Even if the actual deals they pick are home runs, doing 3 times or 4 times their money, that dormant cash that sat there for years pulls the overall fund IRR down from a potential, say, 35% to maybe 20 or even less.
Just because money was sitting there being lazy for too long.
Exactly. Now look at Fund B. Fund B uses the modern just-in-time capital model. They don't take your money until the exact second they need to wire it to the seller of a company. You keep the cash until they call for it.
So the clock on the IRR calculation hasn't started ticking for me yet.
Precisely. The IRR clock only starts when your money officially enters the fund. By delaying the capital call, they dramatically shorten the time period of the investment from your perspective, which mathematically boosts the IRR.
So the fund looks like a better performer.
A much better performer.
Even if they bought the exact same assets at the exact same price as Fund A.
Yes. The multiple of the money might be identical, but the IRR looks far superior because they played with the timing.
So the capital call mechanism is essentially an efficiency tool, but it's an efficiency tool designed to maximize the reported rate of return for the GP.
It's efficiency for the GP, but it shifts the burden of liquidity management entirely to the LP.
Right.
Now, you, the investor, are the one who has to sit on the cash. You have to figure out how to earn that 4 or 5% in your own money market account while you wait for the call. The problem is now yours.
And this leads us directly into the current market environment, because managing that liquidity has gotten a lot harder and a lot weirder recently. We mentioned the $2.62 trillion in dry powder, but the notes for our deep dive mentioned something called aging capital. What does that mean?
This is a fascinating and, frankly, slightly scary trend that's developing. Private equity funds have a shelf life. They don't exist forever. Typically, a fund has a 10-year life, maybe with a couple of 1-year extensions.
Okay.
The first 3 to 5 years of that life are the investment period. That is the only window of time where the GP is allowed to call capital from you to buy new companies.
So they have a deadline, a use it or lose it clause.
Exactly. If the investment period is 5 years and they hit the end of year 5 and still have 40% of the committed capital unspent, that capital usually expires. The LPs are released from their obligation to fund it.
Which sounds good for me. The LP, I get off the hook for that money, but it's absolutely terrible for the GP.
It's catastrophic for the GP. First, they lose the management fees on that uncalled capital, which is a huge revenue hit. Second, they lose the chance to earn carry their 20% share of the profits on that capital.
But the reputational damage is the worst part.
That's the real killer. It signals to the entire market that they couldn't find enough good deals to invest in. And that makes raising your next fund, Fund 6 or Fund 7, almost impossible.
So right now in 2025, we have a lot of capital that was committed back in, say, 2020 or 2021 that is now hitting that 4 or 5 year mark.
Yes. 2024 and 2025 are the crunch years for funds from the 2020 and 2021 vintage. And this creates a very perverse incentive. You have all these GPs sitting on enormous piles of aging dry powder. They need to spend it before it expires.
Which can lead to what you call forced deployment.
Right. They start buying deals just to get the money out the door. They might overpay for mediocre assets. They might lower their underwriting standards.
Or they start drifting from their strategy.
A huge red flag. Maybe they're supposed to be a healthcare-focused buyout fund, but suddenly they are buying a chain of car washes or a widget manufacturer because it's the only deal they can close before the clock runs out.
And on the flip side, if they fail to deploy it, if the capital just expires, you get what's known as a zombie fund.
The Walking Dead of the financial world. A zombie fund is a firm that has deployed some of its capital, maybe it performed poorly, and then it has a huge amount of uncalled capital that expires. They can't raise a new fund because their performance is bad and they failed to invest the last one.
So they just sit there.
They just sit there for the next 5 or 6 years of the fund's life, collecting their management fees on the old assets they did buy, slowly trying to wind them down with no future.
It's a miserable place to be for the GPs and a very frustrating place to be for the LPs stuck inside.
Well, let's get really practical for a minute. I want to walk through the actual life cycle of a capital call. So I'm an investor. I've signed the papers for my $10 million commitment. I'm going about my life. How does this actually happen? What's the first step?
It starts weeks, maybe months, before you know anything is happening. The investment committee at the private equity fund approves a deal. Let's say they've agreed to take a public software company private for $500 million.
Okay, step one, the deal is signed. Step two is the calculation. The GP's back office, their finance and accounting team, goes into overdrive. They take the $500 million purchase price, then they add all the associated transaction fees.
Lawyers, bankers, consulting.
Millions of dollars in fees. Then they'll add a working capital buffer for the fund itself. Then they'll calculate the management fees that are due for the quarter. Let's say the total all-in need for this transaction is $520 million.
Then they have to split that bill among all the different investors in the fund.
Correct. Step three is the pro rata allocation. They pull up the master roster of all the LPs. If your $10 million commitment represents 1% of the total fund size, then you owe 1% of that $520 million.
So $5.2 million.
Right. And then, step four, you get the email.
The notice.
The capital call notice. It usually arrives about 10 business days before the due date. Sometimes you get lucky and get 14 days, but rarely more than that. It's a very formal legal document. It's not a casual request.
And what's in it?
It lays out the precise amount you owe, the exact due date and time, the wire instructions for the fund's bank account, and usually a very brief, sometimes cryptic description of what the money is for. Something like, for the investment in Project Titan.
10 days isn't a lot of time to get $5.2 million together and wire it out.
It is not. And this is where the stress comes in for investors. If that money is sitting in T-bills, you have to sell them and wait for the cash to settle.
Yeah.
If it's in a different currency, you have to execute a foreign exchange transaction. You have to move fast and be organized.
And does this happen in a smooth, predictable way? Or is it lumpy and unpredictable?
It depends entirely on the asset class and the fund's strategy. If you are in a big private equity buyout fund, it's very chunky and very fast.
Chunky meaning large calls.
Very large. They buy big whole companies. They might call 20% of your total commitment in one single shot for one deal. Typically, a buyout fund calls 60 to 80% of its capital in the first 3 years of the fund's life.
So you know the pain is coming early and it's coming hard?
Yes. It's front-loaded. Venture capital is a totally different beast.
How so?
It's a slow, unpredictable burn. A VC fund might only call 30% of its capital in the first 2 years. They're writing much smaller check seed round Series A investments. But, and this is the absolute kicker with VC, they reserve a massive amount of their capital for follow-on rounds.
Because in the world of venture capital, the winners need more fuel to grow.
Exactly. That's the whole model. You make 20 small bets, 18 of them fail, but 2 of them take off like rockets. For those 2 winners, the VC needs to protect their ownership percentage as the company raises bigger and bigger rounds of funding, the Series B, the Series C, the Series D.
So they hold back a huge portion of the fund just for those later checks.
A huge portion. It's not uncommon for a VC fund to reserve 50% or even as much as 60% of the entire fund just for follow-on investments in their existing portfolio.
This creates a really weird counterintuitive dynamic where in venture capital, getting a lot of capital calls is actually a good sign.
It's one of the strange truths of VC investing. If your VC fund is calling capital aggressively in years 3, 4, and 5, it usually means the portfolio is winning. They have breakout companies that need more money. They're doubling down on their successes.
And if your inbox is silent, if they aren't asking you for money in those middle years,
it often means the companies they invested in early are dead or zombies. It means they have nothing worth putting more money into. In VC, silence is often the sound of failure.
Okay, this is fascinating. Now we are getting to the part of our deep dive where we put on our sort of detective hats.
My favorite part.
We've talked about the traditional way this all works, but over the last decade, maybe 15 years, a piece of financial engineering has completely taken over the industry. The subscription line or subline.
This is the elephant in the room. You talk to old school private equity guys, some of them absolutely hate it. The new school, the younger generation of managers, they can't imagine living without it.
So what is a subscription-backed credit facility? Let's break that down.
It is actually exactly what it sounds like. The fund, the partnership itself, goes to a massive bank. A city, a JP Morgan, or specialist lenders like Silicon Valley Bank used to be a huge player here. And they take out a big line of credit.
Okay, a loan.
But here's the crucial part. They don't secure that loan with the companies they are buying. They secure it with you.
With me, the investor.
With your commitment, your signed subscription document. The bank looks at the list of all the LPs in the fund. They see the Yale Endowment, the Ontario Teachers Pension Plan, a couple of well-known billionaires, and the bank says, these people are good for the money. Their promise to pay is a high-quality asset.
So the bank will lend the fund hundreds of millions of dollars against the promise that these investors will eventually pay up.
Correct. They are borrowing against your credit score, essentially. The bank underwrites the quality of the LP base. If you have a gold-plated LP list, lots of sovereign wealth funds and pensions, the bank will lend the fund money at a very low interest rate, maybe 90 cents on the dollar of total commitments.
And if the LP base is a bunch of random rich dentists from somewhere,
the terms won't be as good. The interest rate will be higher, the advance rate lower. The quality of your fellow investors directly impacts the fund's cost of capital.
Okay, so the fund gets a credit card, basically. How does that change the mechanics we've been talking about?
Well, originally, the stated purpose was for administrative ease, for smoothing cash flows.
Smoothing?
Yeah. Let's say the fund has a $50,000 legal bill due next week. They don't want to issue a formal capital call to 200 different investors to each wire in $250. The bank fees alone would be annoying. It's a huge administrative headache.
Sure, that makes sense.
So they just pay that $50,000 bill using their credit line. They put it on the card. They wait until they have, say, $10 million of small expenses and fees accumulated, and then they do one single larger capital call to pay off the line.
That sounds reasonable. A genuine efficiency. Nobody likes nuisance paperwork.
And that was the Trojan horse. That was the original sales pitch. But once these credit lines were in place, the GPs very quickly realized they could do something much more powerful with them. They could use the line to manipulate time.
Manipulate time? How?
Remember our discussion about IRR? The clock starts ticking when the capital is called from the investor.
Right.
So imagine the fund agrees to buy a company in January for $100 million. But instead of calling your capital, they draw $100 million from their bank line and use that to close the deal.
Okay. The deal is closed. The asset has been purchased by the fund.
But you, the investor, haven't sent a dime. Your money is still sitting in your bank account, earning interest for you. The fund holds that loan from the bank for 6 months, 9 months, maybe a full year. Then finally, in December, they issue the capital call to you.
And I send them the money, and they use my money to pay off the bank loan.
Exactly. So as far as your performance report shows, your money was only at risk or invested starting in December.
But the asset, the company they bought, was hopefully appreciating in value since January.
Precisely. By artificially compressing the time period of your investment. By shortening the denominator in the IRR calculation, the annualized IRR shoots through the roof.
Can we put some real numbers on this? How big is the distortion we're talking about?
It can be very significant. Let's say an investment doubles in value over 5 years. Simple math, that's a roughly 15% IRR. Now, if you use a subscription line to delay the capital call by a full 12 months, so your money is only in for 4 years instead of 5, that same deal might suddenly show an IRR of 19 or 20%.
You've just created 400 or 500 basis points of return out of thin air.
You've created optical return. And this is the critical part that investors need to understand. Did you make more money in absolute dollar terms? No. The multiple on invested capital, the MOIC, the cash-on-cash return, is exactly the same. In fact, you probably made less money.
Because of the interest on the loan.
Exactly. The bank isn't lending that $100 million for free. They're charging interest. And that interest is an expense of the fund, which you, the LP, ultimately pay for. It reduces the net asset value of your investment.
So you are paying real cash interest to a bank in exchange for the GP being able to show you a higher but ultimately artificial IRR percentage on a piece of paper.
That's the trade-off. It's a classic case of misalignment of incentives. The GP is heavily incentivized to maximize IRR because that's how they market their next fund. The LP pays the real cost of that marketing exercise.
That feels, I don't know, a little bit like smoke and mirrors, or at least misaligned.
It's fully disclosed in the fine print of the fund documents, but yes, it creates a fundamental misalignment. And there's a real risk aspect to it as well, beyond just the cost.
What's the risk?
Interest rate risk. Back in 2021, when interest rates were near zero, this was a no-brainer for GPs. You borrow at 2% to buy assets you hope are growing at 15%. Easy arbitrage.
But in a higher rate environment like we have now,
The math gets very dangerous. If the fund is borrowing at 7 or 8% on its subline, and the asset they bought is only growing at 6%, they are actively destroying value every single day they don't call the capital from you.
they are using leverage on a losing trade.
Exactly. And the LP usually has zero control over when the GP decides to pay off the line and call the capital. You're just sitting there waiting while interest accrues and potentially eats into your returns.
It also completely messes up my liquidity planning as an investor. If I look at the fund's deal announcements and I expect a call in January, but the GP uses a line and doesn't actually call the money until December, I'm sitting on cash for an extra year for no reason.
It breaks the predictability.
Yeah.
And then when the line finally matures, and they usually has to be paid off within 360 days, you get a massive bullet capital call out of the blue. Instead of small, frequent calls tied to specific deals, you just get hit with a generic repay the credit facility call for 40% of your total commitment.
So, sublines are a true double-edged sword. Great for reducing paperwork on small items, but very dangerous for distorting returns and increasing risk.
You have to understand what you're looking at.
Okay, now let's talk about the nightmare scenario, the part everyone is afraid of. What happens if I get that 10-day call notice for $5 million and I simply don't have the money?
This is the defaulting investor scenario. And in the polite, clubby world of high finance, this is where the gloves come off. The penalties for defaulting are not just strict. They're designed to be punitive. They're designed to be irrationally harsh.
Why so harsh? I mean, if I miss a credit card payment, I get a late fee and a nasty letter. Why is this so different?
Because of the structure of the partnership. A fund is a chain, and every LP is a link. If you break your link, if you don't fund your $5 million share of the $500 million deal, the fund might not be able to close the transaction.
The whole deal could fall apart.
The whole deal could collapse. They could lose their deposit. They could be sued for breach of contract by the seller. They could suffer massive reputational damage in the market. One person's default endangers everyone else's money.
So it's a systemic risk to the fund itself.
Exactly. So the limited partnership agreement, the LPA, is written to absolutely terrify you into paying on time. The first step is usually punitive interest. You miss the wire cut off by an hour, boom, 10%, 12%, sometimes 15% interest starts accruing on the unpaid balance immediately.
Okay, that hurts, but for a short period, it's manageable.
That's just the warning shot across the bow. Next comes disenfranchisement. You lose your rights as a partner. You can't vote on fund matters anymore. You lose your seat on the LP advisory board. You are effectively silenced and ostracized.
And if I still can't come up with the cash?
Then comes the haircut. This is where it gets truly brutal. The GP has the right, under the LPA, to take your entire interest in the fund, all the money you did already contribute in prior calls, and sell it. But they don't have to sell it at fair market value. The contract allows them to sell it at a massive discount, often 50% of the last stated net asset value, or even less.
They can fire sell my assets to punish me.
Yes. And who do you think they offer that discounted stake to first?
The other investors in the fund.
The other investors. So if you had put in $2 million previously, and you default on a $100,000 call, they could sell your $2 million stake to me for $1 million. You just lost $1 million instantly, and I just got a fantastic deal. It's a wealth transfer.
That is just wild.
And in the absolute worst case scenarios for a flagrant intentional default, there is a forfeiture clause. The GP can simply seize your capital account.
Yeah.
You lose 100% of everything you've ever put in. It's a total wipeout.
Is that even legal?
You sign the contract. And courts in Delaware, where most of these funds are domiciled, generally uphold these clauses because of that systemic risk argument. You endangered the entire partnership, so you forfeit your stake.
Now, there is one more twist here that affects the other investors. The innocent bystanders. The overcall provision.
Yes. This is why you need to know who else is investing alongside you. Let's say you and I are both in a fund. You default on your $5 million call. The GP still needs that $5 million to close the deal on Friday.
Right.
The GP can turn to me, the non-defaulting investor, and say, hey, your partner didn't pay. You need to cover his share.
Wait a minute. I paid my share on time. Now I have to pay yours too.
Yes. Most LPAs allow the GP to issue an overcall to the good investors to cover the shortfall of the bad investor. Now, usually it's capped. I might only have to pay an extra, say, 25 or 50% of my own original commitment size. But yes, I am effectively forced to step up and lend money to the fund to cover your mistake.
This makes me realize that when I join a private fund, I'm not just betting on the manager's skill, I'm also betting on the solvency and reliability of all the other LPs.
You absolutely are. You are entering a partnership with 100 strangers. If the other LPs are flaky or over-leveraged or just poorly managed, they become a direct liability to you. This is why top-tier GPs are so incredibly picky about who they let into their funds.
They want the big, stable money.
They want institutional capital, pensions, endowments, sovereign wealth funds, the kind of investors that will never, ever default. They are terrified of having too many high net worth individuals who might go bust in a recession or get a divorce and suddenly have a liquidity crisis.
Let's pivot to the listener for a moment. If I'm an investor or I'm advising someone who is, how do I actually construct a portfolio to manage this without getting crushed by these liquidity issues?
It is without a doubt the hardest part of being a successful private market investor. It's called liquidity management or pacing. You have this large looming liability, your total uncalled capital. You have to match that liability with assets that can be turned into cash quickly.
But as you said earlier, you can't just keep it all in cash. The cash drag would kill your overall portfolio returns.
Right. And you can't just stick it all in the S&P 500 either. Imagine the worst case scenario. It's 2008 again. The stock market crashes 30%. What happens in a crash?
Credit dries up, valuations get cheap.
And savvy GPs see incredible buying opportunities. So what do? They issue a flood of capital calls right at the bottom of the market.
So I have to sell my S&P 500 index fund, which is already down 30%, to fund the capital call.
Exactly. You are forced to sell low in your public portfolio to buy, well, hopefully you're buying low in the private portfolio. But you are crystallizing huge losses in your public book at the worst possible time. It's a disaster.
So what's the professional solution?
You have to ladder your liquidity and create different buckets for the capital you expect to be called in the next 6 to 12 months. You have to keep that in cash or short-term money market funds. You just accept the low return as the cost of insurance.
And for the longer-term commitments.
For capital you don't expect to be called for 2 or 3 years. Maybe you can put that in short-duration bonds. You only take real equity risk with the portion of your capital that you don't expect to be called for many, many years. It requires a very disciplined plan.
We talked about metrics earlier, IRR versus MOIC. If I'm looking at a fund's quarterly report and I see all these acronyms, what should I actually trust? What's real?
You should look at what I call the holy trinity of metrics. You need all three to get the full picture. Those are IRR, TVPI, and DPI.
Okay.
IRR is the internal rate of return. It tells you the speed of the return. We already know that can be gamed and manipulated with subscription lines. So you have to treat it with a healthy dose of skepticism, especially in the early years of a fund's life.
Right. It's the most easily engineered number. What's next?
TVPI, total value to paid-in capital. This tells you what your total investment is worth on paper as of today. If the TVPI is 1.5x, it means for every dollar you've paid in, you now have $1.50 of value.
But paper is the key word there, isn't it?
It is. A big chunk of TVPI is usually something called RVPI, residual value to paid in. That residual value is the GP's opinion of what the unsold companies in the portfolio are worth. They mark them to market based on their own models. But until they actually sell those companies, it's just a guess.
Which leaves us with the third one, DPI.
DPI, distributions to paid in. This is the truth teller. This is the cash-on-cash return. For every dollar I sent you, how many dollars have you actually wired back to my bank account?
You can't fake a wire transfer.
You cannot. You can fake a valuation, you can engineer an IRR, but DPI is binary. The cash either hit your account or it didn't.
I love that phrase I saw in the notes. DPI pays the rent.
It absolutely does. If you see a fund that is, say, 8 years old, and it has a massive TVPI of 2.5x, so lots of paper wealth, but a tiny DPI of 0.2x, meaning they've returned almost no cash.
Ooh.
You should run away. It means they are great at buying companies and marking up their value on paper, but they are terrible at actually selling them and realizing the gains. It's a Roach Motel. The money checks in, but it never checks out.
I want to touch on one last technical topic that came up in the research, which is specifically for our listeners who might be managing tax-exempt money, maybe for a charity, an IRA, or a small foundation, the concept of UBTI.
Unrelated business taxable income. This is a trap that catches a lot of very smart people who are new to this world.
Can you explain it simply?
Sure, the IRS gives tax-exempt status to charities, pension plans, and retirement accounts. But they have a rule. They say if you act like a regular business, or specifically if you use debt to generate investment returns, you have to pay tax on that portion of the profit, just like a normal company would.
And private equity funds, especially buyout funds, use debt.
They use massive amounts of debt. Leveraged buyouts are, by their very definition, leveraged. If a fund borrows money to buy a company, a portion of the profit that flows up from that company is considered debt-financed income.
So even if I'm a tax-exempt charity, I might owe tax on that part of my PE investment.
Yes. And worse, you have to file a specific, complicated tax return, Form 99D-T, which is an administrative nightmare for a small organization. This is why you always hear about blocker corporations in fund structures.
What is a blocker?
It's exactly what it sounds like. For its tax-exempt investors, the fund sets up a separate C corporation, usually domiciled in Delaware or the Cayman Islands, that sits between the fund and the investor. The blocker corporation owns the investment and pays the corporate tax on any UBTI.
So the tax is still paid, it's not tax avoidance.
Correct. The tax is still paid at the corporate level by the blocker, but it blocks the tax filing requirement and the tax liability itself from hitting the tax-exempt investor directly. The investor just gets a clean dividend from the blocker. It lowers the net return slightly, but it saves an enormous compliance headache. If you are ever thinking of investing in PE through an IRA, you almost always need to use a blocker structure, or you are going to have a very angry accountant.
We are coming up on the end of our deep dive. I want to leave the listeners with some truly actionable advice. We've covered the definitions, the mechanics, the tricks of the sublines, and the horror of defaults. If I am sitting across the table from a GP, or I'm trying to read a confusing quarterly report, what is the one question I should ask to cut through all the noise and get to the truth?
This is a great way to frame it. If you want to see if you're dealing with genuine investors or just clever financial engineers, you should ask this. Can you provide your track record showing both the levered and the unlevered IRR? And separately, what is your firm's policy on the average duration you hold deals on your subscription credit facility?
Okay, break that down. Why those two specific things?
Asking for the unlevered IRR forces them to show you the performance of their investments without the effect of the subscription line. It strips away the financial engineering. It shows you the raw performance of the assets they picked.
So you can see the gap?
You can see the delta. If their main levered IRR is 25%, but their unlevered IRR is only 15%, you know that 10 full percentage points of their genius is just coming from borrowing cheap money from a bank and playing with the timing. It exposes how much of the return is real versus engineered.
And asking about the duration of the line.
That tells you about their philosophy and intent. If they say, oh, we typically hold deals on the line for 360 days before calling capital, you know they are aggressively managing for optical IRR. If they say, use it for 30 to 60 days just to bundle expenses, they are likely using it for its original intended purpose of administrative ease. It tells you if they are playing games or if they are playing the market.
That is incredibly powerful. It really stops the hand-waving and forces a transparent answer.
Transparency is the only disinfectant in the private markets.
Let's wrap up with our 3 key takeaways from this deep dive. What's number 1?
Takeaway number 1. You have to understand the difference between the contract and the cash. Committed capital is your credit limit, a legal promise. Called capital is your actual investment at work. The gap between them, the dry powder, is a liability you must manage with discipline. Do not treat it as play money.
Takeaway number 2.
Be cynical about early performance metrics. Beware the J-curve and the optical illusions created by subscription lines. IRR is easily manipulated by debt and timing. Trust TVPI as a measure of paper value, but trust DPI as a measure of reality. If they haven't returned cash to you, the profit is still theoretical.
And the final, most important takeaway.
Takeaway number 3. The entire system is built on trust, and it's surprisingly fragile. It relies on 100% compliance from all partners. Therefore, defaults are not an option. The penalties, the haircuts, the forfeitures, the overcalls are designed to be catastrophic to ensure the stability of the fund. Never overcommit and never put yourself in a position where a market crash forces you into a default.
This has been a heavy one, but I think a necessary one. We all hear about the outsized returns of private equity, but you absolutely have to understand the machinery to survive the ride.
The returns are the destination, but the capital calls are the vehicle. You better know how to drive it before you get on the highway.
This is Talk Tickers. Markets close, but the analysis doesn't. Thanks for listening.